Welcome to the Daily MBA, where business wisdom is served fresh and fast, straight from one of the top MBA programs in the world. I'll give you summaries of my lectures and readings, as well as the most important insights gained from an MBA, so you can apply all of this knowledge in every business. Let's get started. In today's episode, I'll continue talking about macroeconomics. In my previous episodes, I explained the 10 most important concepts. I also talked about currency exchange, inflation, and the impact that had on unemployment. Wrapping it up and continuing with the idea that I had last time, we were talking about how jobs creation could impact the well-being of countries because they would lead to lower unemployment levels and therefore higher output. All of this, it's going to be very important, and today we're going to analyze a model that is going to be talking about the output that a company is generating based on two factors. First, labor, and second, capital. First thing that I wanted to talk about is an important concept that is called the Convergence Path. And so, Convergence Path was something that was established as things that countries could do in order to improve their situation with the output production. And the convergence path was relatively easy because it's just 3 steps, but it was very hard to achieve for emerging countries. First, it's going to be control of corruption. And if you can see most of the emerging countries, this is a big issue. And that's probably one of the reasons why they haven't increased their output and therefore the well-being of the people. So control of corruption is the first step. Second one would be improving infrastructure. So building roads, enabling the country in order to have better commercial purposes and therefore bringing more money into the country. So just improving the infrastructure. And then the third one would be political stability, because obviously countries will only invest in another country if they can be sure that it's going to be a stable country. It won't have political disruptions or political risk. So obviously you want to ensure that you have all of these 3: control of corruption, infrastructure, and political stability. And this used to be called the convergence path. And what would happen in this convergence path, I'm going to show it to you visually, but I'll also walk you through it, is that companies would usually make money flow into their countries because other countries want to invest in this type of countries that are in the convergence path. They are very attractive for investment. Usually they have low labor costs and they have all of the good things that an investor would like. So this starts bringing money in. And as soon as you have money in, you can start advancing in this curve and going into the right. And what usually happens is that you're going to stop at a point where it's not going to be more efficient to keep bringing money in because it's going to be more costly. And now the only thing that could lead to growth could be your people. So labor here is going to be the determining factor. If you can see in the graph, you have 2 lines. One of them, it's going to be the marginal productivity of labor, which is going to start to increase once you move into this convergence path because people are going to start being more and more productive every time. And then the other line that you have is the marginal productivity of capital. And this one, the opposite, is going to start to decrease. So what this means is that initially, when you're a developing economy or an emerging economy, as soon as somebody puts some capital, this is going to have huge returns, so big productivity returns. But marginal productivity is going to start decreasing and decreasing and decreasing when you start becoming a developed economy. Because, for example, now the impact of just investing $5 million in the US would be nothing compared to investing $5 million in Haiti. So you can see this difference. Money will have big effects in developing economies, but it will start losing this effect of output growth when you already have a developed economy. And so once we get to the developed economy, this is going to lead to the intersection point where we have an optimal level of capital over labor. In this, it's also going to be an optimal level of output, if we could think about it. Because output per person is going to be Y over L. And here, it's where it's going to be the optimal. It had been growing this entire time, but it's going to be optimal. So once you get into the convergence path, you're going to grow because the business will invest in money. But then, when you get into a developed economy and you get to this intersection point, technically the growth will start being zero because countries will become more and more wealthy until the output per person stops growing. And so the thing that I just said maybe sounds weird, and it's one of the theories why people think economists are pessimists. But what this would mean is that in the long run, after you hit this target, the output per person won't grow. So technically, the income per person will stay the same. Your quality of life will stay the same. You can't grow further than a level when you've already achieved a developed economy. So this is going to be confusing for some people, but it's how it goes. And why can't it keep growing? Because if you cross to the other side, basically labor is going to be very expensive. It's going to give you productivity, but then money won't. And so this is going to also decrease the amount that you're earning per person. And usually countries won't cross past this intersection because it would be useless to invest or put more money flowing when you know it will have less return than it would if you invested it in labor. And so all of this model is going to be called the Solow model. And when I heard about it, I thought it was solo like one person, but it's Solow with a W at the end, so Solow. And the Solow model is going to be talking about how countries can grow in the future. But there may be a Solow Residual. And so the Solow Residual is going to be basically all of the reasons why a country would grow more than it was expected. Because we have this model, usually in economics, you are predicting it, but then in real life, something happens and it's not like the model. So here, this is what's been happening to many, many countries over the years. When you get in the convergence path, you actually grow even more than the model had predicted. And so why is this? There are 4 possible reasons why a country can grow more than it expected to. First one, it's going to be technology. And so usually this will be related to R&D investments, but technology is great because it will help boost productivity. So you can produce even more with the same resources that you have today. So of course, this is going to lead to higher growth than the expected because you're not changing any of the input variables, yet you are getting more in the output. So technology is probably the greatest booster of the Solow Residual and is one of the reasons why countries may grow more than it was expected. The second thing is human capital. And so human capital doesn't mean that you have more people in the market. It just means that education, so people that are learning, that are doing their masters, are usually going to have a higher impact, not only for themselves, but for the people that are surrounding them. So in my case, I am doing an MBA, but my coworkers are also going to be benefited by this MBA because I'm going to be sharing this knowledge with them. Or you, as a listener to this podcast, are already being benefited from the knowledge that I am acquiring. So together, we are actually making both of our economies grow even more because I am sharing my knowledge with you and you're going to take this into your company or your job. And so you are going to be technically creating more impact just by getting yourself listening to those things and getting more and more educated. So education is going to have this cascading effect of positive things that will impact society. And that's also one of the reasons why countries grow even more than it was expected to. The third reason is going to be financial market development. And so this one, it's going to be very important because usually financial markets are overlooked, but they play very important roles in efficient market allocation. Specifically, they have 4 roles. They are a pool for capital flows, they measure risk, they monitor risk, and they price risk. But so, what does all of this even mean? Financial markets are going to be a place where you can discipline companies. And that can be, first, because you're going to be rewarded if you're doing good things, and if you're doing bad things, you'll be punished, how it happens in any company that's in the stock market. So the people are going to be putting their money into companies that are doing good stuff and taking the money out of companies that are doing bad stuff. This is going to be helping reward and punish people, and it's also playing as a pool of capital. But then also, it sets up standards because you can't go public and be in the stock market if you don't have some specific standards. So basically, that's why financial markets are so important, and they are going to be boosting the economy into getting better and better every time. So this is going to be the third factor of the Solow Residual, which is considered the residual that you're growing more than expected. The last one, it's one factor that actually I didn't learn a lot about because my professor said this one was a little bit irrelevant and it didn't explain a lot, but it's called increasing returns to scale. So this one actually means that you just have increasing returns, but it doesn't explain a lot. The others are way more enlightening, and those are the ones that we usually see in real life. So this 4, technology, human capital, financial markets, and increasing returns to scale, are going to be the explanations of the Solow Residual, which means why a country can grow more than it is expected to. So overall, the only things that I want to say wrapping up this episode about the Solow Growth Model would be that usually developing countries have a low K over L ratio, which means low capital over labor. And the marginal product of capital is going to be really high, and the marginal product of labor is going to be really low. Then, when you join the Convergence Path, and you stop corruption, you improve your infrastructure, and then you have political stability, you're going to start growing at the same rate as labor. So labor, it's always going to be growing because population is growing. And one little thing that I didn't mention about this model is that it will assume that labor is growing exogenously, so out of our control at 3%. But when you start growing more than that, your capital, then you're moving to the right. What if labor and capital are both growing at 3%? Actually, that's a bad thing. It means you're stuck. Because if they are growing at the exact same pace and K is growing at the same speed as L, then your K over L ratio won't actually change. So you'll be stuck where you are. This is what's usually considered as the middle income trap. So you're growing your capital at the same amount that you're growing your labor, and this means that you're not moving around. If you want to move faster, you have to bring in more capital than the labor. So this is going to be the only way for countries to increase their output per person. In my next episode, we're going to be studying a very interesting case about Argentina and how they tried joining this conversion path, but some of the external factors made them actually drop and go back in the recession that they are following. So be sure to check out that episode and also to share my episodes with someone else that wants to learn about business. I'll see you next week.